Hello traders, Gary Wagner here. It is 12:07 in Honolulu, 6:07 in New York on Wednesday, 27th day of September, 2023, and this is the Daily Report for Gold and Silver. Gold prices continue to trade dramatically lower, and in fact, over the last 3 days has given up approximately $54, considering on Monday that gold opened at roughly $1,945. Each day had a deeper and stronger decline than the previous day, capped off by today's decline of $28.90, a decline of 1.51%. The primary force behind this most recent decline has been the exceedingly hawkish monetary policy by the Federal Reserve. The fact that they have been so aggressive in raising rates started the ball rolling, but really what sealed the fate of gold moving below 1900 was the fact that they announced that they would maintain the elevated rates that are currently in play for a much longer period of time, and in fact came out at the last FOMC meeting stating that rather than cutting interest rates next year by 0.25% on 4 occasions, they would half that to cutting it only 2 times. What that means realistically is that interest rates in terms of the Fed funds rate will maintain a level above 5% throughout the calendar year. That took the yields on U.S. Treasuries dramatically higher and also moved the dollar into a space not seen in months. Currently, we have the dollar index at 106.015. In terms of the net gain on the day, that is a gain of 0.41% or 43.5 points. And the recent strong price decline in gold when compared to the current yield of U.S. Treasuries really puts all of that into perspective. The 30-year government bond is currently yielding 4.717%. It's inverted to the 20-year yield, which is higher at 4.915%, almost a 5% yield on the 20-year bond, and the 10-year bond is yielding 4.607%. On Friday, the government will release the most current inflation data, the Personal Consumption Expenditures Index. If that comes in showing that inflation has begun to really soften, we could see a change in the overall bearish market sentiment for gold and exceedingly bullish market sentiment for the dollar as well as U.S. Treasuries. It is clear to see, with dollar strength being so prevalent and yields going up so quickly, gold as a safe haven asset has definitively lost its allure. And for investors seeking safety, the fixed income of U.S. Treasuries, especially the 20-year near 5%, is a safe bet now that gold has breached and taken out the low at 1914. This Fibonacci retracement set, simply put, is no longer needed. And what we need to look at is the fact that gold broke through 1900 and is approaching lows not seen since February and March. In other words, where could gold go now that it has broken through the key and psychological level of 1900? I draw your attention to this area at the end of February and beginning of March when these lows came in at around 1885. We are not that far off from that price point, currently at 1894. This would be the logical place. If gold continues to drop, it could find technical support. All things being equal, it will really depend on the PCE released on Friday to make a determination of whether or not we'll see more damage or support. Silver has also declined for the last 3 consecutive days, although when we look at the fib retracement that we have from 22.28 up to 25.42, it is still within that price range. What is interesting and doesn't bode well is when we convert this to a 3-line break chart. And as you can see, although the boxes have gotten smaller, there is no pivot and it is still in red. I would look at the price point just above $22.50 for potential support in silver. This has been Gary Wagner wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.